Thanks to As You Sow and NYC and ACCR and Carbon Tracker and Jeffries for having us all here today. I'm Andrew Logan. I direct serious work engaging the oil and gas sector. So I've been doing this for 20 years, which I guess makes me either an optimist or masochist or just naive or something. But I think it's probably important to note, important context for this panel, that over that period of time, I think we have seen real change from this sector. Right, companies are acknowledging the science. They are setting. Oh, microphone. Is that any better? No. It is green. It's green.
Bring it closer.
Maybe I have to get really close. Oh, okay.
Yeah, you have to get close. Just want to use this. This seems to be.
I feel like Billy Joel.
I'm going to put this on the table in case.
Aha. Does that work? All right. So just get close to your mics, I guess. Or not. So we've seen incremental progress, right, over time. So we've seen companies acknowledging the science, setting ever more ambitious targets. So ambitious is a relative term. Engaging, supporting in some cases policy on certain issues like methane, developing modest businesses around low carbon and decarbonization. But obviously, there's a big but here, which is that progress, while it is encouraging in some ways, is obviously well short of what we need given the scale and scope of the climate challenge. And I think it's a really interesting time to be talking about the oil and gas industry. We have the head of the IEA, and many of you in this room, I'm sure, have spent many years trying to get the IEA to be more expansive in its thinking when it comes to climate change, and that there has been real change there in the last couple of years. We had the head of the IEA in the Financial Times just last week saying that demand for fossil fuels globally, at least oil, gas, and coal, is going to peak in the next 7 years by 2030. At the same time, I mean, you look out the window right now, and demand for all those commodities is at record highs, right? Even coal. And so, I mean, the big question is, how do we get from here to there, right? From demand ever increasing to a time when demand actually peaks, plateaus, and decreases. So that is what the panel today is going to tell us all about in the next 46 minutes or so. So in the interest of time, I'm not going to go through and give a formal intro to everyone. I'm going to have everyone just introduce themselves as they start speaking. I will say this is a really impressive panel. There are folks here who can speak to the industry, to economic analysis, to pension fund organizing, to investor engagement, to international relations. But I'm going to start just by asking everyone sort of the same question and also let them introduce themselves, sort of a foundational question, which is, is there a role for the oil and gas sector in the low carbon transition? Or should the goal really be just to get them out of the way? Or to put it another way, why should any of us care about this sector at this moment in time? So you're sitting next to me.
Good morning, everybody. I'm Mike Coffin. I head up the oil, gas, and mining team at Carbon Tracker. Yeah, I think it's good. Can you hear me if I speak through this one? Okay, I'll just go off the table, Mike.
Yes. Thank you.
So, I'm Mike Coffin. I head up the oil, gas, and mining team here at Carbon Tracker. Is that still okay at the back of the room? Great. And my background, personally, I worked for BP as a geologist for 10 years in oil and gas exploration. So for the question, is there a role for oil and gas in the low carbon transition? Actually, I think the first part would just be to clarify the question around low carbon transition. Is that transition to a low carbon energy system at some point in the future on some pathway, which doesn't necessarily link to a temperature outcome? Or is the question really, and that's what I'd nuance it around, a transition on a low carbon pathway to a sustainable energy system where a low carbon pathway, where we can reach the goals of the Paris Agreement. So ultimately, that requires a rapid and accelerating decline in fossil fuel consumption and ultimately, clearly, then production too. But clearly, we're not going to stop oil and gas overnight. There will be continued production. There needs to be production, and I think our whole message gets impacted when people say, "Oh, okay, you're calling for oil and gas to stop production." Well, that's not the case. It's clearly about the new assets. And it's ultimately for the role for the industry is to steward that existing oil and gas assets and that production, but focusing on, for example, reducing their methane emissions from their existing assets over time. But ultimately, the energy transition is is not just about climate, and is increasingly about the demand substitution effects of new technologies, as Mark alluded to from his opening comments. And so this is not just an ESG risk, this is a fundamental risk. And all investors, whether they're concerned about climate or not, must take account of that. In terms of the role for oil and gas, they must recognize those risks. And as I say, steward those assets. But crucially, there's no one-size-fits-all strategy for companies here. It may be that a company strategy that's appropriate is a wind-down strategy without the sanction of new projects and allowing existing production to decline naturally over time. It may be that it's in the interest of individual companies to transition to something else, but what that something else is different from different companies. As I say, there's no one-size-fits-all strategy. And it may be that those companies have a role to play in the development of the new technologies, whether that's renewables, whether that's EV charging points, whether that's decarbonisation services, crucially to other industries, not CCS to enable continued production, but CCS to decarbonise those hard-to-abate sectors, whether that's steel, cement, and other things like that, but crucially not just to perpetuate business as usual. And then in the short term, potentially, if you're not on a low carbon, low overshoot scenario, there may be some demand for short-term demand for short cycle projects. So focusing oil and gas companies, focusing any new projects, a limited number, must be focused on lower carbon, but crucially short cycle that can be brought online quickly, will be produced quickly and decline rapidly, and therefore not ultimately perpetuate the system, leaving ultimately assets that are the risk of destroying value over the next decade or so. Let me pause there.
My name's Mary Cerulli, and I run Climate Finance Action. We're a nonprofit, and we work at the intersection of U.S. pension funds and union workers and pension trustees that are union-based. And I appreciate how you framed that, Mike, and I think we're in alignment there. But I feel like we need to care about the oil and gas majors because of their immense sway over federal policy and state policy, and some of those skills that you alluded to are important for the transition, but also the renewables, the offshore wind. And I've read recently that oil and gas workers, about 50% surveyed, said that they envision working in the renewable space. And so that worker mindset is probably pretty important. And there are groups of oil and gas workers that are pressuring their companies. I think BP Offshore might be one of their targets to rapidly move to renewables. But on the other side, there's such a disparity between the sector's promises and outward-facing rhetoric on climate change, and then their nominal efforts to cut their emissions. And most oil majors portray these policies that are as climate friendly when they really aren't. So I'm one of two minds, and I feel like to be very blunt, less bullshit, please. But also, we can't leave the bully in the playground and hope that they'll turn into a collaborative playmate. And I'm a mom, so it would be like leaving the kids unsupervised and just hoping things will work out.
Tough act to follow. Hi everyone, I'm Nick Spooner with ACCR. We are a research and advocacy organisation which use shareholder rights to address global greenhouse gas emissions through our engagement activities. I've recently joined the company. I've been in asset management for the last 6 or so years doing stewardship activities as well. To speak to this question that Andrew's posed as the foundational question, it's first important to not get carried away about the possible low carbon activities that the oil and gas companies are talking about and investing in some cases, but to get to the points that Mike was raising, to really address the elephant in the room in terms of their current activities and their current capital expenditure plans, which are predominantly focused on fossil fuels. And so we need to be prioritizing the constraint around investment on the supply side in upstream oil and gas assets. And that's the primary focus we take at ACCR, whilst also appreciating that, as Mike said, there are many different opportunities and business models that these companies could follow. Danielle mentioned earlier around her concerns around deploying capital and increasing capital deployment into renewables. Certainly there are opportunities for the oil and gas sector. You see that more in terms of the synergies around their molecules businesses, whether that be hydrogen, biofuels, carbon capture and storage. But we've also seen investments on the renewables side as well. And I think there are a lot of possible benefits that the oil and gas companies could bring to the table in terms of their investments here, particularly around their geopolitical ties. When we think about capital deployment into renewables and the clean energy sector, it's also about where that capital is going from a regional perspective as well. The IEA point to the need for investment in developing economies as a priority in terms of increasing that investment by 8x over the next decade compared to around 4x in developed economies. And we've seen from BP and other companies overbidding within some markets and driving prices up for renewables, whilst there's a lack of investment in other parts of the world. So I think that's a really important area of focus as well. So that geopolitical angle. I think another sort of area of focus here is when we think about this from an experience curve perspective. And so these companies do have capital at hand. They've been raking in cash over the last couple of years. And so they have the ability to deploy this and bring these technologies down the cost curve as well. So from a macro perspective, there's some strong benefits there from these companies getting involved. I guess the overriding concern, though, to sort of balance out this discussion a little bit more is this has obviously been in the past historically seen as posturing or greenwashing from these companies. And we need to be very careful about that. And we need to be careful about what is the net zero scenario that these companies are pushing or promoting? What is the net zero world that these companies are hoping to see? And I mentioned the synergies on the molecule side. From an economic efficiency perspective, overinvestment in terms of hydrogen and carbon capture and storage is not economically efficient, and so could produce suboptimal outcomes for society.
Thank you. Can you hear me? Good morning. My name is Luciano Caratori. I lead the energy cluster with the Climate Champions team. Our job is bringing together the non-party stakeholders to discuss with the parties of the Paris Agreement. I joined as oil and gas sector lead, and now I lead the energy cluster. Going to this point, in line with the previous comments, I think that there is a place for them. I think also that this won't entirely depend on oil companies. Oil companies don't exist in isolation. They exist within states. Some of those have a state hat, in fact, because they are national oil companies, semi-private or public oil companies working in that space. They exist also in linkages with communities and in linkages with demand. So we can't pretend, from my point of view, to expect that they will shape their own transition without the guidance or the science from demand, from the regulation, and from communities. And this makes it really complex because they sometimes have the hat of the negotiations when they are part of the country as national oil company. I'm from Argentina. That's, for example, in Argentina, the B20 was led by YPF, which was the national oil company of Argentina in 2018. We are seeing that sometimes these interests of oil companies are aligned, of course, with their mother states or the states they are representing. And there is an increasing push for trying to address energy transitions as a status quo. So we don't really know what an energy transition is exactly. There is not a clear or commonly accepted definitions, but we know something. That's not status quo. So we need to help them shape, help them, maybe it's a soft word, shape their transitions by policy, by demand side, and also by working with the communities, procuring a just transition for them. Why is that? Because one of the key stakeholders for oil companies are the communities they work on. If we don't give the communities they work on alternatives for transitioning, then they will be part of the corporation pushing for keeping the status quo being as it is. Thank you.
Can I just
Go
respond to
ahead,
that? I think we should be careful about not getting disillusioned by the fact that oil and gas companies are just passive recipients of policy, and that over time, they've been the ones lobbying behind the background and driving the policy outcomes to a strong degree. And many of these companies have been exposed, whether it's around hiding climate science by Exxon and Shell over the years, and the continued role that they continue to play, mainly through third-party organizations. So we need to root that out, and we also need to counteract that on the clean energy side.
Yeah, Mayor?
Please.
I absolutely agree with that. However, I think that it is also a risk to consider that they act in isolation. The oil and gas corporation is not oil and gas companies, but also states benefiting for that. So we need to work with companies and with states. Sometimes states, their own, and I'm not speaking about US states, but states worldwide, are lobbying together with oil companies. And we need to keep that in mind to find a solution for this problem.
Great, thanks everyone. And I'm glad that we brought up a few, I think, themes that we'll come back to: national oil companies, policy, transitioning away from things, maybe not toward things, that we'll come to later in the conversation. I do just want to, sort of pivot now that we've got general agreement that this is a topic worth discussing, which is good. Otherwise, we'd have a very awkward next 40 minutes.
We haven't been booed off the.
I do want to sort of transition from the question of is it worth engaging to how do we really accelerate change in this sector? And Nick, one of your colleagues at ACCR, Bryn O'Brien, had this tremendous quote last month, which I thought encapsulates things really well. She was responding to, I think, a reporter's question about, the recent trend among some investors to shift away from engaging the sector and move more to focus on the demand side of things. And she said, giving up on shareholder strategy, having only used engagement, is like giving up on filleting a fish, having only used a butter knife. The fish is still dead and everyone is hungry. Which is a great quote. It does kind of beg the question, though, of what is the sharper knife, right? So I think I would love to kind of get broad thoughts, and then I've got some specific areas I'd love to dig into in terms of how do we go from, again, I think this history of impressive but still incremental change from the sector to the more transformational change that I think we all realize we need to see in the next 5 or 7 years. So I don't know who wants to take on that very vague and broad question, or I can also just dive into some of the follow-ups. But Mike, you're smiling, so I'll
Okay. So I think I was smiling there for two things, and kind of both linked. I think in some ways, and while absolutely have to act on emissions, in some ways, when we talk about emissions, the companies push back by looking at, we'll set our operational scope 1 and 2 emissions intensity target. We'll then come up with all these frameworks for how we're ever so slightly less bad than these other guys, and therefore we're amazing. And actually, and as Nick was saying, and kind of I've touched on, I think it's that elephant in the room of just this new system's coming. It's different, it's better, it's substituting for the existing. It's that elephant in the room about the production volume and the long-term viability of that. And that actually, I think, potentially can, while critical we talk about emissions, absolutely, but actually can we achieve that goal through just really challenging companies on their production plans and get companies to say, why are those viable? And do you really believe that production will be X in 30 years' time? And are you not really, is the duration of these assets really putting a lot of risk into the system? And I think the second point there would actually touch briefly, I'm sure we'll come back to it on the NOC side. And again, this isn't about telling countries that you must stop doing oil and gas production because it's bad for the climate. It's about saying to the NOCs in some ways, ultimately the shift is happening, the demand for your product is changing. You need to reframe your business model for actually to support the long-term fiscal sustainability of those countries as well. So I think those are the two specific thoughts there.
Any other thoughts on that broad framing?
It's probably appropriate that I pick up on things. Shout out to Bryn, who's at the back of the room. It's a pleasure working with her, and she comes out with some cracking lines like that all the time. Yeah, no, it was great. But just to expand on that, I mean, and coming from my background too, of being within the investment industry and doing stewardship over the past few years, what we've seen is this emergence of first bilateral engagement, then collaborative engagement through things like Climate Action 100, the increasing use of shareholder resolutions, and increasingly now director voting and the normalization around director voting. I think we've got a long way to go on all of those fronts, but there are still so many sort of additional shareholder tools that are out there that aren't being used to their strongest degree. And we've seen a couple of examples with engine number one, electing directors. I think there's going to be a big wave of that pushing more climate competent directors. There's a huge need for greater competency on boards at the moment, and then other strategies, legal strategies as well. And this is where ACCR comes in. Within the stewardship industry, there is a bit of a tragedy of the commons that everyone's trying to push out their stewardship reports and meet asset owner demands around sort of box ticking around the number of engagements that they're having, the number of meetings that they voted on, but it's really not linked to real world outcomes. And that's the focus that we take at ACCR in terms of actually reducing real world greenhouse gas emissions. And the challenge is that it takes a lot of work. So we have a very small portfolio of around 14 companies throughout our whole team, and we do a huge amounts of research into these companies, modeling the future emissions related to them and the alignment to the goals of the Paris Agreement. And that really isn't within the capacity of many institutional investors. But we're here to lead the industry and sort of take investors with us and work collaboratively with those investors that want to see that change and want to reduce risks within their portfolio.
Go ahead.
I would just like to focus on the US state pension plans here. Stewardship has become important to them because their beneficiaries and the constituents in those states are demanding some real explanation on what is the stewardship of the state pension plan. So they're beginning, we see hopeful movement within some states where they are really doubling down on their statement of stewardship. They're hiring policy and ESG professionals, directors of stewardship that report up through the CIO. And they're really looking at covering the whole fund. And in the US, at most of these state pension plans, they have a US proxy voting kind of guidelines, and then the global is the wild, wild west. Some of them don't even know what's going on that side across the pond. So they're also taking back some power from the proxy advisor and demanding ISS, Glass Lewis, and others to really look at the language, because when they do their proxy voting audit, some interesting things have come up, not only on the climate side or the director voting side, which is super important, but the way that the language is written, the proxy advisor is not executing the way the state pension plan thought it would vote. And so we really see that focus of what does that state pension plan want to accomplish. So rather than 18,000 votes, they're saying, nope, it's time to focus on a sector. It's time to focus where our risk is. And they're, well, I am an eternal optimist, but I think there is a real momentum for change here if we can recognize the barriers of some of these folks inside on the investment side, but also on the elected side. So state treasurers, they have the same title, they have very different roles across our different states here, and to bring in that those pension trustees so that they can really understand and not be bowled over with business as usual, or we can't do that.
Just to quickly respond to Mary, I think what she was mentioning in terms of organizations, investors trying to cover their whole portfolio really highlights part of the problem, that the stewardship industry is really focused on quantity over quality. And I'd raise the question is, if you're going to cover your whole portfolio, how big would your stewardship team have to be? I think the answer would be like unmanageable, unsustainable for any asset manager. And so how do you redirect your mission engagement to really focus on real world outcomes and forceful stewardship on a select set of companies? I think you don't really need to cover that many companies in terms of driving systemic change and also impacting a large portion of your portfolio emissions as well.
So I think one thing that I wanted to add too was around, while disclosure is really, really important, it's all about assessing plans and company plans going forward. So really being forward-looking. Clearly at Carbon Tracker, we do that, but it's looking at multiple metrics as well, whether that is emissions targets, emissions targets, looking at their investment plans, looking at their production plans, but also the governance side of things. So we've done work around remuneration, for example. So I think accelerating change is assessing companies' plans against these multiple metrics and seeing how they stack up on each other.
Great. Well, I'd love to talk a bit more about the kind of role of boards and sort of the role of shaking up boards in this evolution. I mean, I think many of us, or maybe just me, thought that Engine One would be the start of something broader, right? That whole effort. I mean, granted, it was a unique situation. You know, Engine One had the $20 million that you would need to run a proxy campaign. They were committed. They had their whole rationale. They had in CalSTRS a very patient kind of partner who was willing to work with them. But you know, that campaign sort of came and went, and it had whatever impact on Exxon that it's had. But we haven't really seen that strategy replicated anywhere else. And maybe it's too soon. Maybe this is a long fuse, or maybe just there's a need. Maybe that suggests that there's a need to be more deliberate, I guess, in the investor world in terms of building these sorts of strategies. So I wonder, you know, I don't know, you know, Nick or Mike or anyone kind of who has thoughts on, you know, is the idea of running candidates for boards always going to be a once in a blue moon kind of strategy, or is it something that, again, given the scale of the crisis we're facing, needs to be more top of mind than it has been? And if so, how do you actually make that happen?
Yeah, I hope we're at the start of something big here in terms of more focused around director elections. There's certainly need to be shaking up boards a lot more, especially within the oil and gas sector. To go back to my previous comments around the industry being more focused on quantity than quality, getting quality directors onto boards is a lot of work. We saw that with the amount of work that Engine Number One put in. And so we have to think about how do we approach that from a community perspective in terms of this being a more normalized strategy. So I think there's a lot of difficulty in doing that, finding the right candidates, because at the moment, the general consensus around boards is that this is going to be, as Andrew alluded to, incremental change. We've seen energy transitions in the past. Mostly it's been adding different energy sources and it's happened slowly over time. But what we're seeing at the moment is unprecedented in terms of the scale of change, in terms of the increasing clean energy and the rate of demand destruction that we're going to see. And so there needs to be fresh thinking. There needs to be new faces on these boards that understand the speed of the transition that we're going to experience.
So I think from my side, a few comments there, and I totally agree with what Nick was just saying. I think first one would be just some basic governance things, like not having the same person being your CEO as being the chair of the board. That seems to be a fairly basic one. I touched earlier on executive incentives. So clearly understanding that the board may set a strategy. It may be a really great strategy, but if you don't actually incentivize the executive team to deliver against it, guess what? They'll deliver against their personal incentives. So you might have, I mean, there are examples of oil companies which have they've actually said we're going to have a 25% reduction in production over the next 7 years. That's massive. But their executives are still incentivized to grow production volume more than they're incentivized to act on either emissions or to invest into new businesses. That needs to be solved. But clearly, it's not just about having climate experience on the board, although that is important, but it's understanding a broader energy transition experience as well. So if you are a company that is choosing a diversification strategy rather than a wind down strategy, if you are that, well, guess what? We need to get that experience onto the board. And then the final point I'd make, particularly in alluding to that Exxon example, is making sure that those appointments aren't dilutive in terms of the number of seats on the board. So you're not just adding people, you are replacing people. So that actually those new voices get heard and actually have the impact that they need.
Great. Any other thoughts on that? Or I was going to turn next to the question of investors, right? So not the folks in the room necessarily, though maybe some folks in the room. So apologies if I'm going to offend anyone now, but I guess I want to sort of raise the question of whether, you know, the degree to which the existing investor base in this sector is part of the problem, right? I think there's quite a few investors in the oil and gas space who are very happy with the status quo. You see them rewarding companies that retrench on their climate commitments. You see the diminished support for shareholder proposals on climate that we saw last year. I guess I'm sort of wondering, for investors who want to see the oil and gas sector transition, should we be spending more time engaging other investors as opposed to the companies themselves? Because the companies at the end of the day are going to respond to some degree, what their largest investors want to see them do.
There's a common thread between investors in oil and gas companies and the oil and gas companies themselves. And that, I think, is the hubris to think that there's one more cycle that they can ride and they'll be the last man standing after that cycle. And at some point, the music is going to stop and some people are going to lose a lot of money. I think that's coming pretty soon. That's what we're trying to stop through these strategies.
But Mike, I know you guys talk to asset managers, right? So I'm sort of wondering, one, I love your thoughts on that broad question of are investors part of the problem, but I guess secondarily, what would actually move them, if anything? Is it more analysis? Is it pressure? Or do we just need to, I remember somebody who's now actually on an oil and gas company board, he said a couple of years ago that some companies just need a whole new set of investors, right? Who have different priorities, as opposed to just looking for dividends or looking for a different kind of vision. So maybe that's the way to go.
Yeah, I was going to say some companies and some of the European companies, while there's an awful lot more for them to go, those that are setting out a strategy of transition are in some respects stuck in transition. They've set out a plan to go into a new business model, but a new business model that ultimately is lower volatility but lower returns. So ultimately requires a different set, or it requires those investors to accept that as part of the journey. But it also crucially it requires investors to not say to accept that future oil and gas returns are not going to be the same as historic oil and gas returns. So saying, oh, well, we'll only get 8% IRR out of renewables, but I can get 15% IRR out of oil and gas. Well, that's what the companies said historically they might have been able to get, although reality is they probably didn't on average, but it's not going to be like that going forward. And plus it's going to be lower volatility. So I think it's that mindset change, as you say, within investors understanding that. But I think also there's kind of the analyst community as well. And some of the and the short-termism that pervades a lot of it. We talked about oil and gas executive incentives, ensuring those are appropriately long-term and the correct metrics. But I think there is here a piece around short-termism within the industry as at large, but also understanding and changing some of the benchmarks and allowing a little bit more freedom and a little bit more long-termism there to enable that transition for those companies that are looking to transition as well.
And Mary, you have experience kind of working with pension funds and more from the grassroots side of things. Is there a strategy there to sort of leverage the grassroots to move some of the asset managers?
Well, I was more thinking about, we're kind of dancing around the problem with passives because there's such a concentration of voting power do we still call it the big three, BlackRock, Vanguard, and State Street? But it seems like it's more like the big two. And we know, we're here in New York City, and Brad Lander has been very outspoken on the problems with BlackRock. So we see as part of the work is to look at who are the customers of those asset managers. And in the US where we work, the customers are asset owners, are state pension plans. And so we see some movement for much stricter due diligence, but also pension plan, retirement fund, long-term, short-termism of what you mentioned, Mike. So there is a customer power of these asset owners, and it would be great if they started to work together, which I know has been done, but they need to have a bigger voice or a more powerful demand.
Let's just follow up. Oh, do you want to go first? I was going to pick up on. Okay. Just to follow up on the BlackRock piece, what we've seen is BlackRock passing through the ability to vote to some of the asset owner clients. I'm not really sold on that as a strategy because it's basically BlackRock absolving themselves of their fiduciary duties to manage climate risk and passing it on to someone else. Also, since we've seen the implementation of this, what you do is release the pressure on BlackRock to be voting in a more climate aligned way, in a more Paris aligned way, and exposes them to sort of a more mainstream base, which isn't supportive of climate related resolutions. And we've seen that reflected in BlackRock's support for ESG proposals over the last 3 years, just cratering down to, I think, 7%, which was reported a few weeks ago.
Yeah, I mean, I'd agree with that. And I think the other thing to say would be around asset owners holding their asset managers to account, that if you're saying this is a sustainable portfolio or a low carbon portfolio, why does it contain a whole load of oil and gas companies that themselves are not Paris aligned? So I think that's the role where Carbon Tracker and ACCR and others come in terms of assessing those, providing the materials and the metrics to enable people to easily assess those plans. And then also thinking about individual products, and we wrote a report, Miss Pitch, earlier this year, thinking about, okay, well, if it is an ESG fund, why does that contain 30% invested in oil and gas? But I think there's here a role for regulators as well, and advertising standards, and we've done some work on that in the UK, of how are these products marketed, and is there effectively greenwashing from the asset management industry at large here, but then also thinking through both individual product advertising, low carbon, ESG, sustainable funds, but also membership of things like Net Zero Asset Managers Alliance and others. So if you are signaling to the community through that membership of those and other investor groups or coalitions, then actually are you seeing that through in the way that you're actually is that being seen through in investment practices?
So I'd love to start bringing in some questions from the audience as well. So Danielle, what was the process for that? Are people writing them down, or are we just calling on folks?
I think we can. Where's the microphone? Let's just
The
do the
roving
microphone for
has
now.
gone away.
Hi, everyone. Not sure if it's on. Can you hear me? Hi, thank you so much for the riveting panel. I'm Clara Vondrich with Public Citizen, and please, 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 please don't be offended, but I feel like this conversation, I heard it 10 years ago. And it's painful and it's not your fault, you know, and it's just basically, I think, shows the power, at least here in the US, of the conservatives that have been fighting so hard to slow walk progress by bringing up these chimerical concerns about ESG being risky strategies, which we resolved, you know, decades ago. Question though, I wanted to know about how the engine number one victory at Exxon, how that's concretely changed matters at Exxon. And more specifically, I'd love to hear like the inside scoop, like, are these guys like working really hard and fighting and just getting blown back, or are they quiet? I'm not sure if anyone can answer that, but there was so much promise in that. And I'm a divester, so I wasn't really, you know, that wasn't my bag. But at the same time, when that happened, I had real hope, and that echo is awful. So that was one question. And the second was just another comment that the SEC is coming out with this ESG fund names rule tomorrow. And so the point about making sure what's in the funds is actually what's in the funds is a really big deal. And it's especially important because with the IRA, we have like a $2 trillion investment gap, or IRA gap, they're calling it. Maybe it's 2 billion, I'm really bad with numbers. But it's big, and if the funds actually included climate solutions and were kept to their mandate, then that flow of capital could be much more significant than it has been to date.
Anyone want to take on any of those questions?
I suppose I'd make a comment on the final part about climate solutions. Yeah, absolutely. Clearly, a whole load of very significant amount of money is needed to help transition the energy system. But I think the term climate solutions is potentially problematic in itself, in that you have some of the oil companies talking about their low carbon solutions businesses. But if you know, there may be 30% of their capital investment is going into that business. When you unpack that, it includes gas, it includes LNG, it includes CCS and direct air capture and carbon storage to perpetuate the production. So it's not actually a decarbonisation service for other industries. It's effectively, greenwashing itself. So I think that would be a comment from me. I can't speak to the engine number one in any more detail. I would flag that our corporate research analyst Neil's here, so you could talk perhaps in Exxon in a bit more detail outside the room as well.
Yeah, I can't speak to Exxon either, but maybe just on the fund labeling, when we think about where you can derive impact within public equity markets, it's not through divestment. That's what the academic evidence is showing. And so with this fund labeling, that's showing what a sustainable portfolio is in terms of it just being invested in low carbon stocks. And one of the most infuriating things is when that means just tech stocks. But if you want to have real world impact through public equities, you have to have a portfolio that's engaging with the problem with the oil and gas companies. And we just don't really see that. It's not a popular product out there. And the fund labeling disincentivizes that.
I'll just say that the idea that divestment doesn't move equities, it's such an old and tired argument. That's not why we do it. That's not the primary reason. It's to provoke a social license. It's created a movement of hundreds and thousands of campaigners around the world. So
Can
it's
you use the mic because there's hundreds of people on Zoom that are not hearing this conversation.
Great. Any other questions from the room? Oh, Hilmi. Sure.
Thanks very much. Can you hear me okay? Apologies, I'm recovering from a cold. The question is for any of the panelists. It's about net zero transition plans for oil and gas companies. Just curious if you have any view on using intensity metrics that relate to the distance traveled for the hydrocarbons. Seems like that's been something the API has been pushing for a little while. And I'm curious, is that something that's credible, or is it also potentially useful from a spatial perspective, as now more projects are getting focused on for their resilience benefits?
So I think my overall comment on net zero transition plans for oil and gas is those plans should be assessing the pace at which companies are moving away from the legacy oil and gas business, and ultimately the pace at which that business and the production will decline over time for that company. And that's not just about selling off a load of assets potentially to buy some new assets. It's about effectively stewarding that and winding that down over time. And then crucially, if you go and invest in some renewables, that shouldn't somehow negate or give you kind of credit for the fact that you're continuing to develop oil and gas. So inherently intensity targets, particularly on a scope, scope 1 and 2 intensity, important to reduce, particularly around methane, but ultimately you're still dealing with 15% of the problem and not the 85 plus of the end use emissions, hence the importance to wind down. So the specific point there on distance traveled, well, it depends on the transport method, but the reality is transporting crude around the world in a ship is actually in large volume is not that emissions intent, not a huge part of the problem. The problem is the flaring, the methane at the well site, and then crucially the end use combustion. And specifically talking about scope 1, 2, and 3 emissions in our ranking of company targets, those that use an intensity approach, say someone like Shell, the problem is that if you're looking at the intensity of your overall energy production, you can reduce your intensity and make progress against your target simply by increasing your renewables production. You potentially even could grow your oil and gas production under that. So that's why it's critical that we set scope 1, 2, and 3 absolute targets with interim goals as well. And I think as a case study, BP made clear it was going to roll back its production targets, so smaller reduction than previous, had to update its climate targets to reflect that, the absolute component. Shell did similarly with the production targets, but did not have to update its climate targets because ultimately the climate targets weren't constraining, if you like, and are actually reflecting the absolute part.
Mike, in that line, and always taking into account your reports with Carbon Tracker, just for the sake of the rest of the audience, maybe someone who is not that into the metrics, our problem is with carbon and other greenhouse gases in the atmosphere. Anything that distracts us from the rate in which we as a world are bringing carbon and methane to the atmosphere is not good enough for transition planning. So we need absolute targets, and we need to be sure that any divestment or reduction in those absolute targets in a company-wise matter is not being transferred into another company which is not subject to stringent regulation. So that's the rule of the thumb. We need to reduce the amount of methane and carbon in the atmosphere. Everything else is a distraction. But one more thing on that, scopes 1 and 2, when it comes to methane, there is vast agreement in the IPCC reports, Secretary General Antonio Guterres, IEA, and others, that we need to urgently address methane in the short term. So we need to be sure that we will keep that stock in line, but also that we will address methane in the short term. And sometimes it looks like there are not enough incentives in terms of the words to do that, because methane abatement has a negative abatement cost sometimes, let's say for the 40 to 60% of the whole methane oil and gas operations, and they are still not doing it at the pace we need them to do it. So we need also to put much more attention on how we ask and how we demand for this abatement to happen urgently. That's great.
Ilmi Granoff, I'll just step over here. Columbia Law School and LSE, couple hats. Two questions, both engagement questions. The first one is, there seems to be an implication when we start talking about revenue destruction, instead of talking about carbon pricing and supply constraints, that when you're in the financials, you move from one side of the balance sheet to the other. And when you're talking about carbon pricing, it's a liability. You're talking about supply constraints, it's a liability. And when you're talking about revenue destruction, it's on the asset side and the erosion of the value of those assets. I'm wondering if engagement discussions reflect this kind of shift as to where in the financials the problem shows up, or if we're even in the financials at all. That's question one. And having some other abstracted discussion from the value of the company. The second is, under almost any scenario, the size of oil and gas companies declines. And that may be of great value to the shareholders as they spin out profits and spin out dividends to the shareholders, but as they decline in size. Are there any examples where management has been rewarded for shrinking the company profitably? Because I see an ego and sort of cultural problem. What can investors do to signal to at least one of these CEOs that they would like the company to shrink because it is in their interest as investors?
I can go first on that. I mean, I think the incentives to shrink a company and return cash to shareholders are there. Most of the incentive packages that you see for these companies have EPS or TSR metrics that are the predominant factor in there, which does incentivize it. We can raise questions around whether that's a good thing, but in many cases, that is a good use of capital for these companies, because the opportunities for investment going forwards with a decreasing sliver of potential projects that are viable under Paris Agreement is limited, and so it's probably the best thing to do. What was the first question again?
Revenue versus liability.
Oh, I see. Yeah. The main thing to be focused on, and this is linked to that, is around stopping investments in new projects, and that comes to the investment framework and the commodity prices that are included in that. In terms of the way we look at this from a supply side cost curve perspective, most of the projects that are in play are going to be okay. There's going to be some value destruction in terms of the assets that are there, but the real value destruction is on any new investment in projects that are higher cost and where those costs aren't sunk already.
So I've got a couple of comments on the first one. So totally agree with the question. How do you incentivize and get away from a growth is best kind of, biggest is best, I'm, best person here. Oh, okay, I'm going to be rewarded for making this work. I think that I totally agree with you, but I think I'd slightly counter there with while the TSR metrics, whether they're absolute or relative to peers as well, should in theory incentivize that. If you still have incentives that directly incentivize, either directly or incentivize production volume growth that outweigh the ones at the other end that are acting on emissions or acting to transition to the other businesses, you're still going to be steered in that growth mindset. And I think the other part is those metrics, particularly when you look at the LTIP, so long-term incentive plans as opposed to annual bonus, a lot of those are paid in shares. So the value of that is based on the market consensus of the company, which if it comes back to the previous question around investor sentiment, and if we need to see fundamental change in the investment community, because otherwise the CEO is only going to get that reward if they actually do the thing which changes market consensus, which is continue with the status quo. So I think just a couple of other comments on the problem, but yeah, totally agree. How do we incentivize companies and individuals to make a company get smaller and maintain value?
And Mike, in that line, I think that for several years, those who have been working in climate for like the last decades, sometimes our thoughts were on how can states catalyze this change. And now, in some cases, what we see is that the challenge is to help states keep the pace of the demanded change by society. And we're talking about carbon prices. But fossil fuels have negative carbon prices today. IMF report 3 weeks ago said that the fossil fuel subsidies hit record heights in 2022. Since the Pittsburgh summit in 2009 until 2022, we are still every year above the previous year. So we need to cope with fossil fuel subsidies before and while we work on carbon taxes. We have a negative carbon tax on fossil fuels right now, and we need to address that as soon as possible. Thank you.
Great. Well, I know we're running low on time. I'll ask just one last question, and then if folks want to give any final thoughts they may have. But I guess one of the implications of some companies shrinking is that market share for OPEC is probably going to grow, right, in the transition. And Luciano, you sort of had alluded to national oil companies, and this sort of there's some threads I'm trying to connect here, which is if as an investor your main concern is going after the emissions wherever they happen to be, right? We have national oil companies that in many cases are higher emitters on a percentage basis, right, than some of the IOCs. They're going to be growing market share into the transition. Is there an argument for investors to spend more of their energy trying to develop strategies to engage NOCs where that's possible, which may not always be the case, and perhaps less on some of the IOCs? So I don't know. I mean, Mike, I know you guys you've included some NOCs in your analysis, so would love to get your thoughts, but I guess everyone's thoughts on this kind of broad question of, if investors are going to be ruthlessly focused on how to maximize the impact of what they're doing, does that argue for greater focus on parts of the industry that have gotten less attention up until now?
So I think it's important to think about the NOCs in some ways as two groups. The group that is entirely state-owned, and then the group that is at least partially listed. And of course, those companies are partially listed to help give effectively social or credence, to their operations and help attract investment and financing as well. So I think this year we've incorporated increased focus on the NOCs in looking at, say, our emissions targets. So yes, I think there is very much a focus there, and I think it's clear to see that the NOCs lag, particularly the leading European IOCs when it comes to emissions targets. We often get, okay, where does Aramco sit relative to its peers? Well, it sits right at the bottom, basically, compared to others. So I think the focus obviously should be on the partially listed ones. But I think if you take someone like Equinor, clearly about sort of half, thinking about their investments and their non-operated investments. So particularly the point around methane, which I completely agree with. We real focus on methane. If you look at someone like Equinor, its Norwegian fully operated assets are pretty low intensity. They've got power from shore, but it's thinking about their investments in the Middle East as well and elsewhere. And I think that is a critical area that we can engage on companies.
I just have a quick question for you experts here. Aren't investors exposed to NOCs through like their banks, their relationships with banks who are doing some of the financing for these state-owned companies?
Yeah, and through debt directly as well.
Sovereign debt, mostly. Yeah.
So I don't know, Luciano, do you want to add anything to
Yeah.
that?
One quick thought on this. I think that we do need to engage with everyone, and that includes NOCs. I think that we can't afford to give up on anyone, and that we need this change to happen as soon as possible. One of the or two big characteristics of these NOCs are, first, they have two hats, the company hat and the country hat. Second, that a portion of their demand will not depend on third parties because they can be consumed inland in their own countries. And third, because the sustainability of the NOC sometimes is related to the sustainability of the country debt. So we need to engage with them to avoid a potential long-term or medium-term crisis, not only for companies, but also for countries. And for doing that, we need to address simultaneously the intensity, the methane, as Mike mentioned right now, and also the scope 3, meaning the production and the consumption. So I think that in the next few years, we need to put more focus on that and find different ways to approach them, maybe through debt, maybe through taking into account in sovereign debt, the risk that countries and NOCs are facing in the context of the transition. And that could be also a signal to help them transition to a more sustainable model.
Great. Well, I think that was a good note on which to end and tease up the afternoon conversations on banks and insurance as well. So you guys join me in thanking the panel for the question.